Ladies and gentlemen, we are officially live. No one's on yet, so I don't know who we're talking to. Give this a few minutes while people start to hop on here. Ladies and gentlemen, we are officially live. No one's on yet, so I don't know who we're talking to. Okay. Want to make sure people are popping on. Do we have signage? If you go to the other page, it should say. Well, either way, hopefully people are hopping on. For those who don't know, my name is Tony DiUlio.
It says 0 viewers.
No, still might be talking to nobody. Give it a few more minutes while people start to sign on to this. I can tell my assistant out there is getting phone calls about it because she keeps looking at me saying it's a live stream. So I think we are on. I think we're good to go. Trying to figure out if there are other issues getting people on here or not. Give me 1 second.
It says 0 viewers, but in the message it says on.
Oh, okay. So it definitely seems like
This
people
is
are on.
Oh, you just started clicking. Timing out.
All right, well, I think we're on. If you are on this, if you shoot something into the chat, let us know that this is actually working, that you can hear me. I've done, probably 6 or 8 of these things, and we're still working on the tech. So feel free to join in the chat. Let us know that you can hear me. I know there's been some good feedback on this, so I expect there to be some good comments, some good questions. For those who don't know, my name is Tony DiUlio. I'm a partner and owner of Wheeler, DiUlio, and Barnaby, and we are property damage litigators based out of Pennsylvania and Philadelphia, but doing cases all over the country now. We focus our practice on largely first-party insurance, but also handle really anything involving property damage, whether that be as a result of a contractor, a bad real estate deal, whatever the case may be. If it comes to damage to the property, we can help. But I do these classes, these lunch and learns, really focused on first-party insurance claims to help explain to the industry exactly what we can do to help as a whole. If we have a unified approach, we've found it significantly better results for the industry. You've got to remember, we are up against one of the largest industries in the world when it comes to insurance companies. They've got more money than they know what to do with. They've got lobbyists, and they've got a very good unified approach as to how to handle these claims. So we need to do the same on the other side. Today's topic is Policy 101. And the goal today is to really have people understand what an insurance policy is, what makes up an entire policy, what all the nuances mean within those policies, so that when you do a policy review for coverage or for a client, then you can actually have a better understanding of what you're looking at. I have had adjusters who are brand new all the way up to serious veterans, 40 years in the industry, who still don't seem to have the best comprehension as to what insurance policy really is, what makes it up, and what it all means. So the goal of today's class is to really start to break down an insurance policy, what you're looking at, and how to use it so you get the right understanding. I'm going to give this another 2 minutes before we officially start the program for this, so that people have a chance to log on, only because I can see through the window here that we're still getting some phone calls about people wanting to join in. We're going to continue to do these at least once a month on different topics. So if you're sitting on here right now, I would love to hear things as to what you want topics on for future lunch and learns. Throw it into the chat. One of the best things about this chat and being able to do it is on Zoom or on Facebook here is that we can reach anybody anywhere. So if you've got questions, if you want a topic, something you want to learn more about, let us know. We're always looking for more information as to that. On top of that, because this is live, you really should take advantage of using the live chat for questions. Behind the camera right now is my partner, Mario Barnaby, who's going to be able to answer questions. And he's tech savvy enough to be able to update the slides live so we can add questions on. So throughout the presentation, anytime you have a question. Doesn't have to wait until the end. Anytime you have a question, throw it in the chat. We're happy to address those. Also, when you sign up for these, as a number of you know, you have an opportunity to put questions there. We upload the slides ahead of time with those questions, and I really do try to address everything. A lot of times there are questions that are off topic that I'll put at the very, very end, kind of after we've addressed everything on topic, because I want you to feel like you really can ask any question and get an actual response during these talks. So with that being said, let's start our class for Policy 101. Again, this is going to be focused on understanding the insurance policies. One of the things I always want to plug beforehand is a local group known as Mapia. Mapia is just one of many organizations across the country that addresses public adjusters and the issues that we deal with in the industry. Mapia is the Mid-Atlantic Public Insurance Adjusters Association. We are for Pennsylvania, New Jersey, and Maryland. And really what the goal for Mapia is education and lobbying. Those are the two main issues that we've got that we want to address. So we have yearly meetings. Right now we're planning our holiday meeting that is live in person. It involves an open bar, lunch. So there's really good benefits there, but it's also networking with other people in the industry, getting to ask questions, and live CE credits. All part of the membership. There's no added cost for any of that stuff. So I would highly recommend going onto mapia.org and joining. It's a couple clicks now online. You can use your credit card, and it's all tax deductible, which is a great thing as well. So join in. The big thing that we are able to accomplish is we have a fantastic lobbyist who works with Mapia to make sure that we not only monitor what the insurance companies are trying to do when it comes to regulations, but also try to take some offensive and try to make some changes in the lobbying world when it comes to things like the New Jersey contract, getting meetings with the Department of Banking and Insurance to address the issues with public adjusters. There's so much good that comes from that, and for a measly $300 a year, it is an organization that is really worth joining. So now that we've done that, we're going to talk about today's topics. Now, this is really a class for everybody. I can't stress enough how I've had problems with even guys who have been doing this for forever. This is really going to be helpful for all of you. We're going to talk about a few things. And some of this is going to sound basic, and I recognize that for guys that have been doing this for a long time. Guys or girls, I should say. There's a lot of great women adjusters I know. But one of the things we're going to talk about is what really is the deck page. What information can you get out of it? What is it really telling you? We're going to go through what actually makes up the full policy. That might sound silly, but I've got more adjusters than not that when they send me the policy, it's not the full policy. In fact, what they send me is a renewal packet. So we'll talk about that. We're going to talk about the two main sections of the policy when it comes to property coverages and liability coverages. We're going to talk about how those sections are broken up, and one of the first sections is called additional coverages and what that really means, why it's important. We're going to talk about the actual coverages of the policy itself, the exclusions, some differences between an HO policy, a BOP policy or BP policy, and the CP policy, and so much more. Not really so much more, but I wanted to throw it on there because it sounds nice to end. But let's jump in. Again, as you have questions, I really want you to bring them up throughout the course of the chat so we can add them to the list at the end. Some fun things I wanted you to understand early on. There's two interesting facts that I've learned over the years that I always think about every time I do a policy review. And the first is that in 1993, the NAIC, which is an organization of insurance commissioners from all across the country, they meet every year, sometimes in really fun places like Hawaii, which I intend to go to next time. They introduced the Property and Casualty Policy Simplification Model Act. The whole goal of the act was to say, look, insurance policies need to be written in a way that is simple and understandable by all people. That's great, only it didn't work. And what we had is this readability scale. It's called the Flesch scale. And what it measures is the readability of a document. And as you can tell from this, they use a scale from 1 to 100. The lower the number, the harder it is to read. So the examples that we found were the Bible is a 66.97 on the readability scale. Easy to comprehend to some degree. Einstein's theory of relativity, one of the geniuses of existence, his theory was 17.72. Again, the lower it is, the harder it is to understand. Insurance policies were at 10.31. Really let that sink in, that insurance policies are harder to understand than Einstein's theory of relativity. That's insane. And despite NAIC's best efforts to, in their Model Act, to say things like, you need to use short, simple sentences, simple language that everyone can understand. The fact of the matter is, it didn't work. One of the main reasons this is such a problem is because what's happened with the law, just as a little bit of a background, these policies have been fought for decades, right? And insurance companies know what the outcome on a legal battle will be based off of current language. They don't want to change the language because they don't know what the court will now do with that new language. So that we're stuck into that kind of this perpetual usage of the same old, confusing language in these policies that just simply don't make sense to anybody. Hopefully after today's class, you'll have a little bit better understanding. So, the average HO3 policy, a number of people that I know that join these calls focus a lot of their adjusting on homeowners claims, although this class will be true for commercial losses as well. All of the information is really usable in all fields. But the average policy, I did this test myself, looked at 14 of the major carriers for homeowners claims. And I'm curious what you might think is the average length of an insurance policy. If you're really up for it, you can throw it in the chat. I'll be curious to see your answers. But size really does matter when it comes to these policies. Not necessarily in a good way. But why I say that is you've got to recognize that the size of these policies that you're getting is usually representative of if it's going to be the complete policy or not. Not always, you're going to want to look into it, but it really does matter. So hopefully you've added a few into the chat. I see Mario typing back there. So we've got the average policy length is 70 pages. 70 pages from the top 14 carriers in the area for how long these policies actually are. Now that includes the deck pages, it includes the coverages, it includes all of the endorsements, but that's what your average is. That's crazy, because I will tell you from experience, when you ask for a policy from an insurance company, you're really not going to get 70 pages. And we're going to talk about towards the end, because a lot of the questions focused on it, how do you get that policy? But that's something you need to know going into this. So, you guys are the experts. You've got to recognize that you do have expertise in these fields. I don't care if you've been doing it for 1 year or 50 years, you are still an expert in the field. So you want to recognize all of the issues with these policies, and you should know the policy. And the only way you can know the policy is to read it. Every policy truly is different. So we're going to go through kind of an understanding of some different basic forms that are out there when it comes to homeowners. I'm focusing on homeowners because when it comes to BP or CP policies, they really are all different. They choose different forms. They've got so many different variables. There's no way to kind of go through just a baseline for those. But what I can tell you is once you finish this course, you'll have an understanding of how to figure out what is in that business policy, even if we don't go through those specific ones that you've got. So taking a look, HO1. Now this is your basic named peril policy. It's for the structure only, and there is no liability. And what that means is a lot of times you'll have a property where a property owner wants the absolute barest bones of coverage. They don't care about someone getting hurt on the property. They don't care about any of that. They just want basic forms when it comes to coverage. A lot of times this is going to be limited to things like only fire and lightning. You probably won't have a lot of wind, rain coverage in these HO1 policies. So if you see an HO1, know that you've probably got a limited amount of coverage. Next is the HO2, which is the basic named peril for structure and then contents, and there is liability coverage. So now we've added on a few things. We've got contents coverage in the HO2, and we've got liability coverage as well. Those two added coverages obviously give you more ability to resolve claims, so make sure you review it. But the really big takeaway is it's named peril. Assuming you know this, but just in case you don't, named peril means that your policy only covers a specific list of enumerated items, of causes of loss. It'll say fire, lightning, wind. I'm trying to think what else is on the form. It's in essence, there is a list of items that go down that are ultimately covered. This is contrary to the next one, our favorite, well, not really favorite, but the most common, the HO3. HO3 policies have the exact same coverages as an HO2 when it comes to contents and liability, but it's an all-risk policy for the structure. What does that mean? All-risk language generally says that you are covered for direct physical loss to the property that's not otherwise excluded. And that language will change between the policies. And it is really important. One of the first big takeaways is that you should always check the language of the HO3 all-risk section in the policy, because they will say one of a few things. Allstate will say something like sudden and accidental direct physical loss to the property. And they'll use both those terms, sudden and accidental. Not everybody does that. Allstate is one of the few carriers that actually has the word sudden in there. That makes a difference in how you adjust your claims. If it only has accidental direct physical loss in there, now you don't have to worry about the timing of the loss. It's not your burden to prove that. It will be the burden of the carrier to prove that it's some long-term event that is otherwise excluded. So know the fights that you need to make, because you never want to have to oversell a claim to a carrier. Another important thing about the HO3 is that they're supposed to be owner-occupied historically. Now that's an interesting issue because constantly it comes up, residence primacy issues under HO3 policies and how they play out. We did a whole lunch and learn on that. I would tell you to go back and watch that because we're not going to be covering it all today. Next is the HO4. This is your renter's policy. These HO4 policies only will cover the contents for the property, and you can get some liability coverage in there as well. There's no coverage for structure because the renter does not own the property. Note that this is different than a landlord policy. When I say a renter's policy, I mean this is the policy that would be taken out by the renter themselves. HO5. This is really one of the best policies that's out there because it's all risk coverage on both the structure, like an HO3, and now the contents as well. And under the HO2 and the HO3, the contents are still named perils. That means they still have to be caused by a specific listed item as to a cause of loss. The HO5 uses that same all-risk language of any accidental direct physical loss or any risk of direct physical loss for the contents as well. HO6 is your condo policy. I really am not a fan of condo claims. Pretty much anyone that does them has an understanding that they will become more complex and more annoying than your normal homeowners because you're also going to likely have to deal with the condo association's insurance. Condo policies are unique because they're really excess policies over that condo. If there are items that are covered under the condo policy first, that's going to take precedent. It also covers only the betterments and improvements to that condo. So a lot of times when you've got an HO6 policy, you're going to see really low limits. You might see a policy limit of $30,000, $40,000. That's because all they're really getting out of the HO6 is the coverage for the things that they've improved within the property itself. Anything that was original to the condo before the purchase is covered under the condo association's policy. There's also obviously contents improvement or contents coverage under the HO6 since all the stuff in there in theory is going to be the condo owners. Now, I mentioned this once. Let's see if anybody caught it. Which two carriers have the same HO3 policy? I've asked this question a lot in a different talk, so if you know the answer, feel free to throw it in the chat. But we talked about all these different forms, and does anyone know two of the carriers that have the same HO3 policy? Be interested to see what this chat is when I get behind the screen and rewatch this to see what people are posting. Because being in the field, it's always interesting to see what you guys, recognize when you're out there or not. But that's probably enough time. So the answer, none. No two carriers have the same HO3 policy. It simply doesn't exist. And that's because the carriers are using modified forms that we're going to talk about a little bit. There simply is never two carriers that have the same policy. That's important because you need to read these policies. You could read the Allstate policy 100 times, and if you get a State Farm claim, it's going to have different coverages. So you need to make sure that you are rereading these. In addition, the carriers are starting to get more clever with changing the policy language. So just because you read State Farm's policy 2 years ago doesn't mean it's the same one today. All right, so the deck pages. This is kind of your index to the policy. This is going to be your guide to what should be in a policy when you get it. A lot of these screens, I don't expect you to be able to read everything. We're going to do pop-ups on this. But what the deck page tells you is two really important things. It tells you what your coverages and your limits are for it, and it also tells you what forms are included within the policy itself. There's been some dispute and debate in the legal world as to whether or not the deck page is actually part of your policy or not. I know that sounds strange, but the real question is, well, if the deck page says one thing and your policy forms say another, which one holds true? The fight that we always say is, well, whichever one's beneficial for the insured holds true, and that's generally where the courts have come down. But a few places have actually come back and said the deck page is not actually a part of your insurance policy. But these deck pages will generally have the same information. Like I said, they've got your coverages. So up here at the top, we've got a listing of what the coverages are under the property. And we've got your coverage A, B, C, and D, and your policy limits. These are really important to check on every single claim you have. And the reason it's so important is a lot of these policies, especially business and commercial policies, will have co-insurance penalties. If you don't know what a co-insurance penalty is, generally it says that you need to be insured for at least 80% value of your property. And if you are not insured for 80% value of your property, then we are going to give you a penalty. I've never really understood the concept of it. If you've got a building that's worth $200,000 and you only insure it for $100,000, why does the insurance company care? It doesn't change anything for them really, but regardless, it exists. So you want to make sure that when you're going in here that you've got recognition of that, so that when you're estimating the loss, you're keeping in mind, all right, our policy limits are this much. I need to make sure that as this is presented, it doesn't look like there isn't enough insurance on this property. The other important thing to look at is your limits when it comes to coverage D. Now, coverage D in most policies is going to be your loss of use, your ALE, that type of coverage. And this changes depending on who the carrier is. This is an example from a USAA policy, but it's up to 12 months and it's an unlimited amount. That can change for different carriers. You could have up to 24 months, you could have unlimited forever, or you could have an actual policy limit amount. And knowing that and going into the adjustment with that knowledge can really change the game when it comes to the speed that things need to get done. Because if you've got a specific number limit on ALE, you've got to make sure that the carrier is constantly being reminded that, hey, your insured's going to run out. You can't delay this thing because it's going to be on you, carrier, to make up that difference if it's your fault this thing is going too long. On top of that, we've got your Section 2 coverages. Section 2 is going to be something we're not going to talk a ton about today because it's really not something that comes up for you guys. What I will tell you is under the liability section, and we fought this fight and we're successful, if there is a trigger under the liability portion of a claim, and this came up with an oil tank under the ground, a property owner, the state found out that there was the oil tank, they were required by the state to remediate that oil tank, get it out of the ground and fix it up. That triggers liability coverage. When that gets triggered, you're allowed to adjust that claim. There's actually no limit within the public adjuster law that you can't adjust it simply because the coverage falls under liability. So know that you have these outs to try and get that coverage. But this is the first place you're going to look when you're looking at a policy to see what coverages there are. After that, and this is a little fuzzy here, you're going to look at the forms. This section is the number one section that I find public adjusters are not looking at. I don't know why. I don't know what has been trained in the world to result this, but this section of forms is absolutely critical. Real quick, this is the zoom of what we're looking at here. And what this list actually does, it says these are all of the forms that are contained within your insurance policy. And this is everything that you need to have when you ask for a certified policy. This is your guideline. This is your index as to everything that needs to be contained in there. So for this USAA policy, we've got a quick reference, preferred protection. That's an endorsement on here. Preferred protection plan, an amendment to the contract provision, the New Jersey special provision, special loss statement, water backup or sump pump overflow, and the New Jersey workers' compensation endorsement. All of these, this is what, 7 different forms. All of them are part of this policy. And this is it. This is the whole kit and caboodle, as they say, for the policy and what you need to be asking for. So when you ask for the full policy and you get an email from the carrier, step number 1 is go here and say, okay, I've got 7 different forms that need to be included in my policy that was sent over. And then you go through and you check. I just dealt with this the other day where I was dealing with an agent who said, I actually called them on the phone. I said, hey, my client has been asking for the policy. They didn't get it. She's like, I sent it to him twice. I'm like, okay. I didn't want to push her because it was my first time talking to her, but I had a feeling that she just didn't understand what she was sending. So I tell her, hey, send it to me personally. Just make sure, and I send an email, can you make sure all the forms are included? I want all the forms and endorsements. Please make sure they're in there. She sends me the policy, and it's the exact email that my client did get from her, and it does not include all of the forms. Because I went through and I was able to check on these and determine, hey, you're still missing, and it was some critical forms. I mean, it was literally the special form for a business property that had the base coverages. Even that wasn't in there. So these insurance agents, when you make these requests, they might not know what they're talking about either. That's why it's so important that you do. Because again, when you're making these requests, and there was a ton of the questions that came up, if you're not getting the full policy, what can you do? Well, the first step to that is knowing that you don't have the full policy. And you're going to want to be able to point out, hey, I appreciate you sending this, but you didn't send me over form X, Y, and Z, and actually be able to list those. So let's talk about what some of these numbers actually mean, because these are the key to what you're actually going to get. This is the numbers. These are the letters that actually matter. So let's talk about what these mean. The first number, the way this is normally listed, we're going to show other examples of this, is you've got 2 letters to start. Here it's HO, representing homeowners. Then you've got 4 numbers that generally will follow, and then you've got 2 more numbers at the very end. Often they're in parentheticals, the 0708 here. In most policies, not most, every policy, the starting letters, whether it be HO, BP, CP, whatever the case may be, represents the line type, it's homeowners, business, so on and so forth. The numbers that come after, the first 4 numbers that come after, are the form numbers and the type of the policy. So if it were a 00 or a 01, it's the primary form for the policy, and then it gives you the type of that form. The last 2 numbers here are actually a month and a year. So you know when this form came into existence. So in here we've got July of 2008 that this form was made. Why does this matter to you, right? Why do you care what all of these numbers mean? Well, one of the big things that you're going to want to be looking for is the year that the form was in place. And you can actually figure out when you're looking at a policy, do I have a new form on here for an insured that's been with State Farm for 20 years or USAA for 20 years? Because if they've been with them for 20 years or 30 years, this 08 or this 2012 form has been changed. And you now know, hey, were you ever made aware of this change? Did they reduce coverage? And you can actually push for additional coverage because they were not properly notified of that. I mean, this gets really deep into what can be pushed, but this is what can make a big difference for a lot of property owners. On top of it, understanding what these form numbers mean allow you to do searches if you're in a crunch and can't find it. This is what you're going to be looking for when you're not sent your policy and you need to go and try and find a copy, and go on Google and do a search for these form numbers. This is the format that you're going to want to use to do that search. If you can find the actual form number, and we're going to show you in the policy where this is located, if you find the actual form that has the same nomenclature as in the deck page, you can be pretty darn confident that this is the same form that the insured has in their policy. So understanding this, when you don't get your policy, these are the numbers you're going to look up using this format, LL, and then a bunch of numbers with some spaces that we're going to show you. That's going to be what you're looking for. So let's take a look at some examples of how these look. So these are 3 different policy forms, 2 for commercial properties, 1 for homeowners. And this is a homeowner special form that you're probably going to see all the time. And we've got HO for the homeowner, 00 is the primary form number, 03 is the special form, and then we've got from May of 2001. That's what this represents. Same thing down here, just in slightly different formats as to the commercial policy and the business policy. This is the stuff that you're going to be looking for. This is how you input it into a Google search engine or if someone else uses Bing, I don't know. Whatever else you may use, this is what you want to look for to try and find those forms. So let's look at the policy itself, as I call it, the meat and potatoes of the policy. There's some important things that you're going to be looking for that we were just talking about and where you're looking for them. So in this policy, again, pretty large, I can't read a ton of it, but you've got your base stuff, but then you've got additional information up here in the right corner, down here on the left, and then down here by the page numbers. All of this information actually means something. I remember when I started in this career, this was just gibberish to me. I had no idea of the significance of it and why it was even there. I assumed it was just some Bates numbering type thing. That's not the case. It actually means something. So taking a look here, we've got the HO 9R02 from 0708. This is the policy form, if you'll remember, that we saw right back here. HO 9R02 0708. So once we see that, now we've got another important piece of information on here as well. On the bottom of this page, this is actually another example of an HO form. This is the special form we talked about. It says there's a little copyright symbol, and it says ISO Properties Inc. 2000. Now, this matters, and you might not understand why yet, but hopefully you will in a second. ISO is the Insurance Services Office. They are the largest organization that actually puts out these forms for insurance carriers to use. Insurance carriers have to pay to use the form as part of their policies, but in essence, they do the job for the carrier of writing them. And that these forms, the idea being that they're generally accepted, they've been approved, yada yada. And when you've got a policy that has this, you can know, okay, they are representing that this is the copyrighted form from ISO from 2000. This is important information because if they veer from this without identifying it, they're going to have a problem. So if you do a comparison and start to understand and have knowledge of what the ISO form from 2000 is, which again is always the same form from 2000, and you see something that varies in there, the carrier is now going to have a problem because they're representing that it is the ISO form. The other nice thing about these ISO forms is ISO releases bulletins every year. And the bulletins help explain what some of the policy conditions mean or don't mean, what the intent behind the language was. And they put that in there instead of trying to edit the language because they think the language is good enough, it just needs some clarification. This might not seem significant, except the COVID claims that have been coming out and going through litigation. One of the really big things that started all of this was that ISO in 2004 came out with a bulletin that in essence says, under the current language of some of these business policies that we've written, there might be coverage for viruses. We might not have done a good enough job. So if you're going to be using these forms, we recommend adding in a virus exclusion. That was really big for the litigation for COVID because if the virus exclusion wasn't in there, we now have a bulletin from the drafters of this document, in essence, that says it might actually be covered. So if you start doing this digging and really start to get knowledge as to this industry of what these policies mean and understand these ISO bulletins, it gives you a huge leg up. Insurance adjusters don't get this. There's no way they've got the knowledge or the understanding of this deep dive of stuff. So if you send them an ISO bulletin as to the language, you've got a really good chance kind of blowing them away and ultimately getting coverage for your loss. So on top of that, we've got another version of a form. Now this was from a CP policy, a commercial policy. I can't remember who the carrier was. Oh, Selective. And so we're looking at this, again, not our clearest of photos, but what matters is this language down here. And it's got something a little bit different. And it says it's a copyright from 2015 from Selective, all rights reserved, and then it uses this language, includes copyrighted material from Insurance Services Offices, Inc. with its permission. Now, this or something similar to this is what you're going to see in the large majority of policies nowadays. Because what carriers are doing is they're taking the forms from ISO and modifying them. It's a modified ISO form. That's the term of art. So they're going through and saying, okay, we're going to start with your language, but we're going to change it to mean what we want it to mean. This is so critical because this all goes back to the idea that insurance policies are all different. There are no two carriers that have the exact same forms. So you need to understand when you're looking at it what you are actually looking at. And if you've got this adjusted form, you can use some of that, the adjustments, knowing where the adjustments were made within the policy to argue why the coverage is or is not appropriate for whatever the given loss is, whether it be an exclusion isn't appropriate because they changed it from X to Y, right? And you can use that ISO form to say, well, this is what it said before, and you changed it to say this. You can only do that if you didn't want it to mean the same thing, and thus this does or does not apply accordingly. It can make a real difference in adjusting these losses. So what you're normally going to see, and I don't think I have any slides on the renewal, from carriers is a renewal package. And what that renewal package will have is just the deck pages for the policy and any new endorsements or changes to the policy that are required to be sent. It's usually going to be somewhere around 20 to 25 pages, maybe a little bit less, but that's going to be the main thing that carriers send. I don't understand why agents don't get this, because if you contact your insurance agent, this is generally what they send too. It doesn't make sense to me. The reality is a lot of insurance agents don't know this stuff. They don't understand what makes up a full policy. They don't understand how to break down the forms and seeing it in the deck page and comparing it to the actual forms. They're just not trained on it. I mean, they're just salespeople. So without that knowledge, you've got to make sure you are the one to do that. So if all you're getting is the renewal package, you can know that by seeing I've got deck pages, I've got a limited number of endorsements, usually the new ones that are attached, and I've got to go get some more documents. So let's talk about the policy sections, this is how the policy itself is laid out. Now, we're going to look at the HO policy again, because the BOP policies, the business policies, and the CP commercial policies are so different. I'm going to focus on HO here. However, there are some special forms that are used for business policies, specifically the BP policies, that use the same, very similar layout. They're much more form than with commercial the policies. So the commercial ones are the more complex, but this layout is still going to be generally true almost across the board. And as you can see, we start with table of contents, you go into your agreement, the definitions, then the property coverages section. And you talk about the areas that are covered first, then the areas that are not covered. And then for some strange reason, and I don't know the logic behind this, but they give you additional coverages first and then tell you what your base coverages are. It doesn't make sense to me. It feels like they should give you your base coverages and then tell you, hey, on top of that, you've got this, whatever. Then you're going to go into your losses not insured, then Section 1 loss settlement and Section 1 conditions, and then finally Section 2 for liability. We're going to break down some of these important ones, but understanding that this is your form will help you in just your speed of reviewing a policy, because you're going to have an understanding of, okay, well, what sections for this loss do I need to review for X, Y, and Z reasons? So the agreement section, this is constantly overlooked. I would bet money that pretty much nobody on this viewers watching this right now has actually read the agreement section of the insurance policy. If you have, more power to you. But this section can actually matter. It can actually make a difference in some of your losses, because it's important what this section actually says. Because this is the baseline of the agreement between the two parties. So this is a sample. I believe this one was State Farm, if I remember correctly. But it's got some critical language in here, just when it says to, based on your premium, we're going to give you the coverages that you choose, yada, yada. But this last paragraph is the one that I want to focus on. This is when you request changes to this policy, or the information or factors used to calculate the premium for this policy changes during the policy period, we may adjust the premium in accordance with the change during the policy period, and you must pay any additional premium due within the time we specify. Okay, well, I want to break this down just a little bit. So, number one, if you request a change to a policy, you got to pay the difference. Easy enough, no problem. But the second part or the information or factors used to calculate the premium for this policy change during the policy period, and we may adjust the premium in accordance. Well, this sentence here does a lot. Because first it says that if the factors change, they can calculate a difference. Okay, it doesn't say we have to notify them of a change. That actually isn't contained anywhere in this policy. It just says if it happens. More so, it says if factors change used to calculate the premium for this policy. Well, they're not letting us know what factors are going into calculating the premium. So what the courts have come down and said, in essence, is, well, look, hold on, carrier. Yeah, you can change it, but you can't rely on this language to force a homeowner to say they have to tell you of anything that might change the premiums based on the policy calculation, because how the hell are they supposed to know? Right? There's no way an average homeowner is going to know what factors are used to calculate the premium on the policy. I mean, that's nuts. Candidly, I couldn't even tell you everything that goes into the calculations of that. It's all a bunch of rate stuff that goes on behind the scenes. So you want to know if this language is in there, because if something did change, let's say 2 months ago, the homeowner had to move out for a couple of months to live with their mother while on hospice, who knows? If it happens during the policy period and they didn't notify them, where does it say they had to? It's not. So knowing that language and having it is important. So here's another carrier. All they write in the entire policy are the agreements we make with you. We make the following agreements with you. And then they go right into their policy language. There's no preamble. There's nothing else. It just goes right into the language. This entire paragraph, this entire section that's here for State Farm isn't here for this one. I think, I'll say it was Liberty, but I can't remember. I should have noted it. So moving on from, so we've the table of contents is easy, the agreement. The definitions section. The definitions outlines every word in the policy that it has a specific definition. Now, the definitions themselves can be helpful when it comes to things like residence premises, insured property, named insureds. Things like that can be really important. But what's more important generally is what's not in the definitions section. And the reason that's so important is, as I've mentioned 1,000 times probably, if there's any ambiguity within the policy, then it must be read in favor of the insured. It's because these are contracts of adhesion. So if there is a term that the carrier is relying on to a denial, and you've got a different interpretation for what that means, if it's not in that definitions section, then it's something that you could point out as an ambiguity and get them to change their position. Really, your only goal in that scenario is going to be, look, do you at least recognize how I'm reading it versus how you're reading it? I'm not telling you you think I'm right. I'm not asking that. All I want to confirm is that you understand my reading, that you understand what I'm saying and why I am saying that, why I'm reading it the way I am. It doesn't have to be an agreement. All you need to get is that understanding, and that's enough to fight them on the legal side to say, look, this is clearly ambiguous. There's two terms. Sure, they think it means one thing. Well, I'm saying it's something else, and they understood that. They got that there was a different way to read this, but they ignored it. And that's going to be really great evidence, not only to get coverage, but potentially for a bad faith claim. So now we're going to go into the section 1, the property coverages. This section is really going to be the main area that you're going to be looking at, because it's going to outline what's covered and what's not covered under the policy. The covered areas section of the policy is generally going to be similar. It's going to tell you that the main house is covered, land is not covered. It's going to tell you that there's additional structures coverage for any other structures on the building or on the property that aren't connected to the building physically. And they say things like connections through electrical wiring and patio alone isn't enough to be connected. So it goes through all of that kind of stuff. And it goes through the things that aren't covered, automobile stuff it's unique things. There's some aircraft and boating stuff, probably things you're not going to see a ton of, but important to know nonetheless. Then it goes through those additional coverages. Now for these coverages, you need to read them. I can't stress this enough. I don't know how many different ways to say it on a dozen different webinars, but you need to read these policies. I want to show you a section when it comes to the additional coverages. Knowing what it says, because every policy is different. And here's 3 different examples: State Farm, Allstate, and Nationwide. At least I started identifying who's who. So the first one here being State Farm. This is the additional coverages. The following additional coverages are subject to all of the terms, provisions, exclusions, and conditions of this policy. Okay, great. So I know that when I get down to that exclusions section of the policy, then it likely will apply to these additional coverages. Okay, you've told me that. I get it. Well, Allstate doesn't have that. Allstate just says Section 1, additional protection. And because of that, Allstate has a much harder time stating that any exclusion contained within this policy relates back to the additional coverages. You've got to remember, when you think of an insurance policy, it's just a flow chart. It's the easiest way I can think of explaining this is that you start with your coverages and you just walk through the policy. And it'll tell you if you should go somewhere else or look somewhere else, but you're going to walk through and make that determination. So in this section for under State Farm, I know, all right, I need to look at the other provisions, exclusions, and conditions. Allstate doesn't use that. So your flow chart is going to end in this section where there's going to be additional coverage. And if you start thinking about it that way, thinking about it as that flow chart, then you start recognizing why this specific language is so important. Taking a look at nationwide, we've got additional property coverages. These additional property coverages are subject to the policy deductible, except as noted. In no event will the deductible be applied more than once to any one loss. So that's the end of it. So now we've got a nice combination of these two, right? We're nationwide, they're recognizing that there are other things that we need to address with additional coverages for you. We need to tell you that, the deductible is not coming out twice. But they don't add in the same section that State Farm has. Same issue here that Allstate has, is that under the nationwide policy, you've got an argument to say, well, look, the exclusions don't apply here. It never kicks back. You're also going to want to check out the exclusion section, check out the preambles there, and see if this relates only to things that are under coverage A. Because if that's the case, this isn't coverage A. This is additional coverage. It's a completely different section of the policy. So you're going to be able to really work with the policy and have that understanding to see where does my flow chart end. So we've got the additional coverages, then we go into losses insured. Losses insured is the section that will have that either all risk language or the named peril language. So that if you haven't figured out just by looking at the policy numbers, is this an HO1, HO2, HO3, HO5? If for some reason you don't have the form numbers to make that determination, this is the section you go to. And this is the section that'll tell you really what are my coverages for this policy. And you can generally going to be able to tell that. I know when I started my career and didn't understand what those numbers meant at the bottom, I would just go here first on every policy to figure out, is this an all risk policy? Is it a named peril policy? So you're going to go to the losses insured section and you're going to read it. Again, that's critical. And then after that, you go to the losses not insured. The losses not insured section, as I mentioned before, is important because you've got to see how that relates back to things like additional coverages and your losses insured. And you always want to check for conflicting language. I did a class somewhat recently on anti-concurrent causation and ensuing loss provisions. Those two provisions in 95% of policies are contradictory to each other. And you've always got to remember when you've got that, a section that starts off saying, if any of the following things are part of your loss, it's not covered, whether it's before, during, or after. And then it ends with, however, we do cover any resulting damage that's not otherwise excluded. They can't exist together, and as a result, you've got coverage because you go with the broader coverage that helps the insured. Loss settlement section is how they pay for a loss. Went over something recently with Allstate that their loss settlement provision only allows for payment of repairs if they are doing the repairs themselves. Otherwise, they have to pay for replacement. Makes a big difference on areas that they're trying to patch up when it comes to something like a floor. I got, a ton of questions after that call about Allstate roofing issues. Allstate roofing it's still tough because what they're going to tell you is, well, we are replacing it. We're paying to replace the shingles, not necessarily the whole slope. So the question just becomes really what the extent of that damage is. The conditions section of the policy is important. And the three biggest things that come up in the conditions sections of these policies are the duties after the loss and what falls under those duties. And the big ones are always going to be prompt notice, the proof of loss when requested, and cooperation. Those three are the ones that come up constantly. Under cooperation falls the give them an opportunity to inspect whenever they request. So a few things I wanted to note about those sections. When it comes to prompt notice, generally across the board, the courts have come down and said, look, prompt is really vague. It doesn't really have much meaning to it. So the real question is prejudice. Is the carrier prejudiced by the late reporting? If there's no evidence of prejudice, it doesn't matter if it was 2 months later, 3 months after the loss that occurred. If they can still inspect, they can still have an understanding of the loss, then they're going to be okay. When it comes to the proof of loss, There is no such thing as a form proof of loss. It doesn't exist. No policy includes, at the end of it, this is a copy of our proof of loss. At least not that I've ever seen. So when they ask for a proof of loss, you can use your own. You can also use terms like undisputed. Carriers hate that word, but they like to tell you, oh, the proof of loss can't say undisputed. Where the heck does it say that in the policy? It doesn't. So make sure that you are turning in a proof of loss whenever it's requested, but you don't have to necessarily use their form. And then finally, when it comes to the inspections of the property, they have a right to inspect the property. If they want the inspection, just give it to them. I know it's annoying when they have the engineer come out 2 or 3 times, or have a roofer come out and then an engineer. I get it. It's frustrating, but you're going to have to let them. The courts have consistently said if they want the inspections, they're going to be able to get them, barring something really egregious. And multiple inspections isn't really egregious to the court. But what's really nice to know is in a state like New Jersey, and I'm going to do a class, so I think one of the classes that I come up soon is going to be about the insurance regulations behind the scenes. But New Jersey's Unfair Claims Settlement Act states that an insurer cannot deny a claim simply because there's been a failure to allow them to inspect unless the carrier can prove that they requested the inspection and it was refused by the insured. That's really big, because what that means is when they've got that provision under the policy that says they've got to be able to inspect whenever they reasonably request, and you've had a situation where a plumber had to come out to stop a leak, the carrier can't say, well, you didn't give me an opportunity to inspect the leak beforehand, so I'm not going to pay your loss. Well, if they do that, they've got to be able to show that they made the request and that it was refused by the insured. That never happened. They never made the request. It was never refused. And it's completely contradictory to my responsibility under the property to protect it from further damage. Remember, when it comes to protecting it from further damage, most policies only indicate that you have to keep an accurate record of repair invoices or receipts. So there's actually no requirement in the policy when repairs are necessary to do things like take pictures. With that being said, you should take pictures. It makes everyone's life a whole lot easier, but it's not actually under the policy language. Finally, that liability section, again, not something you're going to need to worry about too often, short of a situation where your insured now has liability and are forced to do something regarding the property. When it comes to repairs like remediation of an oil tank, that can trigger coverage under the remaining portions of the policy. I will say that takes some deep diving into the policy, because what the carriers started doing after we won that case, they started changing it, saying that even if you've got liability for the oil tank, you're still not covered under the property portion. But if you've got an older policy, there's a good chance that you could be successful there. When it comes to understanding insurance policies, this is one of the best books that I've read on the issue. It's called When Words Collide. Bill Wilson's not only a fantastic author, but he was actually an insurance agent who knew what he was talking about back in the day. He no longer is an active agent as far as I know. And him and I have talked about a few things in some email exchanges about policy stuff that he's really smart. Long story short is this book is absolutely worth the read. There's an audio version of it on Audible. You can read it on your Kindle, get the hard copy, whatever you want to do. But you absolutely should be reading this book. So let's get into some of the questions, because this is where a lot came up over and over. What are the best options for the homeowner to get the full policy when the insurance company refuses to provide it? They will only provide the deck pages and or the renewal pages. It's almost like they knew what I was going to be saying. They have tried online and with their agent. So they've exhausted a lot, and this is important because the very first place I go, I tell people, if you need a copy of your policy, find out if your insurance company has an online portal that you can create an account and log in. A lot of them do. USAA has an account. I'm trying to think of other carriers that I've seen. I only know USAA because I had them for a little bit. But you go onto the online portal and see if you can get the documents there. If you can't, your next stop is correct. It's the agent. And you contact the agent and say, look, I need a copy of my policy. And when they send you those deck pages and the renewal, you send a very specific letter. And that specific letter has to say to the agent, thank you, but these forms that we just talked about in the beginning were not included. Outline what those forms are. Make it crystal clear and say, can you please provide me with these forms? And they should be able to do that. If they still don't, your next stop is your insurance company. The insurance companies, as we're going to talk about in the next question, will have a responsibility to reply to that. And if all else fails, the absolute end-all be-all is going to be to contact the insurance department. The local insurance departments, they don't like to get involved with claims disputes when it comes to what's covered and what's not covered, but they do actually get involved when it comes to things like lack of communication from carriers. If you put a complaint in with the insurance department that says, my insurance company, after multiple requests, is refusing to send me a copy of my policy, I can nearly guarantee you that the insurance company will either respond to the department with a copy and CC you, or send it directly to you. It should be your kind of nuclear option because it takes a little bit of time, but it's absolutely where you should be going next. Now, what if the deck page is the only thing available? Let's say you're in an emergency situation. You're not going to have time to get the policy, whether it be a late claim that you've gotten that's been denied and it's coming up on a statute, you want to review something, or for some other reason you want a quick review. You're going to want to look at those policy forms, and you're going to do a Google search for them. And now that you know what the policy form is called, both through its endorsement name and the actual form numbers, you can search for that and see if you can find the form online. Not all of them are there, but a lot of them are. It takes a little bit of digging sometimes, but you can usually find a lot of the forms. Is there a relevant case or statute that we can cite for the few carriers who refuse to provide a certified copy? Yes. Some additional questions are coming in, and I really appreciate that. My partner is writing, but what I'm going to show you are the local statutes. And what each state statute, in essence, does is explains what the responsibilities of the carriers are when it comes to responsiveness. So, taking a look, here's New Jersey. I've got New Jersey's and Pennsylvania's on here. Again, it's where I practice the most often, but I can certainly help you find them for your own state if you need. In New Jersey, the statute says every insurer, upon receiving notification of a claim, shall promptly provide first-party claimants with necessary claim forms, instructions, and reasonable assistance so that such claimants can comply with the policy conditions and the insurer's reasonable requirements. It's compliance with this subsection C within 10 working days of notification of a claim shall constitute compliance with the above. Okay, let's put it into layman's terms. Within 10 days of putting in a claim and requesting the policy, they've got to give it to you. You can cite this and say, look, I need these forms to make sure I'm complying with the policy conditions. How can I comply with the policy conditions if I don't have the forms for the policy? It's nonsense, right? So New Jersey put it in here. Not written as nicely as I would like it to be written, but the reality is this is what the courts have used to ultimately come back and say that in New Jersey, for example, they have to comply with this. There is similar code in Pennsylvania. If we could swap back real quick. Perfect. So this is the Unfair Insurance Practices Act. And this is failure to acknowledge pertinent communications. Every insurer, upon receiving notification of a claim, shall, within 10 working days, acknowledge receipt of the notice unless payment is made within that period of time. And if an acknowledgement is made by means of other than writing, blah, blah, blah. Long story short is once they get this, and there's another provision I think I also cited after this, or at least I should have, once they get notification of the claim, they've got 10 working days to acknowledge it and provide you the policy upon request. And there's another section of this, of 146.5, I think it's C, that says they've got 10 working days to respond in writing to any pertinent communication that suggests the writing would be necessary. And what that means in Pennsylvania is that, just like in New Jersey, when you make that request under this provision, they have to respond to you. They can't just not give it to you. It's a reasonable request, and they're going to be held liable if they don't. It's really good evidence of bad faith, by the way. If something goes south in the claim, and we can show that they weren't doing this stuff, and they're trying to blame us for doing something like making a repair, and we requested the policy, and now they're trying to rely on the policy to say we didn't get to see it. Things like that can really make a difference. So you're going to want to understand that. What value is considered when calculating co-insurance penalty? Market value is usually 80% of market value. So great question. It's actually not market value. Under most policies, it will be the replacement cost. So it's 80% of the replacement cost of the property. So you're going to want, in essence, to do a calculation of what would the replacement cost be of the policy, what is your 80%, and are you there? If you're not there, the policies will give you an explanation of how to calculate it. But, and I can always walk you through it if you need, but in essence, it's going to be a percentage penalty on the loss. So if you're 70% insured, it's not just a 10% penalty. There's math that's involved to do that, but that penalty will be taken on whatever your loss amount is. This could change. Maybe there could be policies out there that say market value. I haven't seen one, but it certainly is possible. So I would tell you, make sure you read the policy. There are a lot of different ways to calculate that replacement cost too. So you can just do a square footage calculation. That's what a lot of carriers do for determining this. You're really going to want to do whatever is most beneficial for your insured when it comes to that calculation to make sure that they don't get penalized. All right, some coverage D says something like actual sustained loss. What exactly does that mean? As long as it takes, question mark? All right, so this is a really good question. Under coverage D, again, that is the section for loss of use. So your ALE, your additional living expenses, and loss of use of the property will fall under coverage D. And this phrase where it says actual sustained loss, I think most of them might say actual loss sustained, but regardless, it means the actual expenses. There are some policy provisions that require actual cost to recover that money. A perfect example is depreciation for replacement cost. To get depreciation back, you actually have to have incurred that cost. Here, it's the actual incurred costs for the loss of use. That's all that this is talking about. So when it talks about actual loss sustained, it means what was the actual incurred costs to the insured, not an estimated amount like so often we're used to dealing with. When it comes to timing, a lot of policies will include provisions within there talking about how long is the period of restoration. That's the POR, is one of the terms of art that's used in the industry, and you're going to see it in a lot of policies, especially in commercial and business policies. You're always going to see it in there. But the period of restoration is how long should the repairs actually take. Now, the difference is that while they make a calculation as to what it should be, they'll use companies like JS Held to try and come up with some really short timeline as to when they think something can be done. The reality is the policy covers the actual loss sustained. In today's losses, for example, I'm dealing with this on a claim right now, the carrier tried to cut off my client's ALE before she could even get a contractor out to the property. And the carrier's position was, well, look, this loss repair should only take 2 weeks. And I haven't really even dove into how long it should take, but it's irrelevant because we can't even get a contractor out there yet. One of the great rules, something else in New Jersey, anyone who's practicing in New Jersey, the carriers, upon request, have to provide a contractor to do the work for whatever the cost was. I'm going to swap to the next slide as I finish up just so that, I don't know if there's another slide. So the carriers under New Jersey statute have to actually provide a contractor to do the work for the cost the insurance company is paying. I don't think a lot of adjusters know that. So you can make a request and say, insurance company, you're saying there's a contractor that can do this. Where are they? And in my case, it's a New Jersey claim, so we made the demand. Carrier's not able to find a contractor to start the work, so they cannot cut off that ALE until we actually can get somebody out there to do it. That's what we're talking about when we're talking about actual loss sustained. Under conditions, what if you mitigate to prevent further damage before the carrier sees the damage? This comes up constantly. I mean, this is one of the most common fights that we probably have because there's this balance that needs to be made within the policy of I've got a responsibility to protect the property from further damage, but I've also got a responsibility to show the damaged property whenever it's reasonably requested. And that's the key here, because what the policy doesn't say, the carrier has an absolute right to see the damage. It doesn't say that. It says you have an absolute right to mitigate, absolute duty to mitigate, no questions, you've got to do that. But then when it comes to the section about inspections, it only says when it's been reasonably requested. And you've got to recognize that they've made no request beforehand. You've got a responsibility to mitigate. You've gone over and above by doing things like taking videos or pictures of the property before, during, and after repairs. You've recorded all the receipts and have the invoices for the work. You've done everything that you're supposed to do. That's perfectly reasonable. It's perfectly allowed under the policy. Now, don't get me wrong. There are scenarios where you're going to want to do what you can to let them out there first. But a lot of times when it comes to things like water losses, they're not going to be able to do it. I mean, if you've got 3 feet of water in your basement and you've got to call a mitigation company, that mitigation company is not going to sit around and wait for the insurance adjuster to show up. It's just not possible. So don't let them use this language about failure to inspect or show you the damage to get out of a loss simply because you had to make repairs. I fight almost every one of these, barring some really significant issues with it. We are always on board to fight these claims because the carriers have no basis within the policy to say, because you mitigated, we're not going to pay the claim now. All right, what is your definition of incurred? Oh man, this one's fun. With regard to loss of use. So incurred does apply to loss of use. It also applies to recoverable depreciation. It comes up in a lot of different areas. So the courts haven't really come down with a clear answer yet. I can tell you from experience what most carriers, at least when things are being done the right way, accept the fact that as soon as a contract is signed, a cost is incurred. There are accounting principles that also stand for the same exact thing. And we've used that in some of our cases to argue why an incurred cost is incurred as soon as a contract is signed. Now, some carriers like to take a harder position on that and don't ultimately try to make a payout when the contract is signed, but that's what the law generally is going to say. Here's the reality of things. If you've got a situation where you believe it is incurred and it's actually going to be incurred, who's going to really care? Now, sometimes the contractor will, but if you can get an agreement from the carrier to say, look, I understand you're not accepting the contract as being incurred. I just need it in writing that when the contractor finishes this work, you're going to make the payment. Put that in writing and I'll give it to the contractor. Everything will be fine and you move on with life. But the fact of the matter is this isn't defined in the policy. There's really not great case law on it. So it does needs to be fought out a little bit more. But we are always of the mindset that it becomes incurred as soon as it is due. When it comes to loss of use, when it comes to incurred costs there, incurred would be the bookings of the hotels. If it's a week stay, day one of that week, if you've booked for a week, the carrier owes for the whole week. When it comes to things like gas, it's not going to be until you make the trip. Utilities, when the utilities are due. Same situation there. But for the stays, those can actually go into the future when it comes to the payments. If there's anything else specific when it comes to incurred that you're curious about loss of use, add it in. I'll be happy to answer the specific question as well. But that's generally what it's going to be for the incurred costs. When discussing photos, if a carrier requests that a wall be opened so an engineer can see behind the wall to determine coverage, if the insured does that, takes photos and puts the wall back, can the insurer demand that the wall be reopened back up so the engineer can be there? Yes, they're going to be allowed to reopen the wall. Might not be the answer you necessarily want, but the reality is as soon as that wall is opened up, they're going to owe for it anyway, at a minimum, to patch and paint that wall. So you've got your coverage triggered when they want to do their inspection, anything invasive like that. But they should have an opportunity to do it themselves. There's really no reason to not let them do it because it's reasonable so long as the carrier is willing to pay the cost of repair regardless of the outcome of the inspection. So if you're doing a smoke claim, my guess is this is either smoke or water, but if there's some question of what's behind the wall, the carrier is going to owe for that wall as soon as it gets opened up, regardless of what it shows. So even if there's no damage or maybe something long-term behind there, they owe for the wall as soon as it gets opened. Can you tell me how to differentiate between HO2 and HO3 with Erie specifically? Yes, so there's two main things that you're going to want to be doing. Number one, it's going to be in the form numbers. So with the Erie policy, I'll have to, again, off the top of my head, I can't think of what the Erie form numbers look like, but they're generally going to say HO0002 or HO0003 for the policy forms. Even if that were not the case, use my old school trick of going into the policy coverage section and determine what it says. And it will say one of two things. Either we cover for accidental direct physical loss, not otherwise excluded, or we will cover accidental direct physical loss not otherwise excluded caused by one of the following perils. And if it has that add-on or some similar language to that, that's going to be your named peril language. So if it specifically says we cover for the loss if it's caused by one of these things, now you've got your named peril policy. If you've got we just cover all accidental direct physical loss, and it says unless otherwise excluded or some similar language, now you're into your HO3. So HO2 is that named peril list, HO3 is that all risk language. Regarding carrier replies, are emails included in the law or just USPS letters? So great question. Emails are just as good, candidly in my opinion, better than letters through the snail mail. It's a lot easier to prove that they've been received and that they were actually sent. There's timestamps. There's so many benefits to emails, but an email response is a written response. It does not have to be via USPS. USPS, yeah. The other important thing is the response is based off the law, and we're going to talk about this when I do my breakdown of kind of the statutes and laws regarding unfair claims practices, but the responses have to be substantive. They cannot just be, hey, we've received your letter, thank you, we'll get back to you. That's not a substantive response. So when they do send a response like that, the timer hasn't stopped. They still have to provide a written response based off of the timeline of the state to actually respond to your question. Does PA have a contractor law like New Jersey? Carrier estimator Mark 1 wrote about 150K, and knowing it wasn't enough, my insured called them out and said, you're hired. They claimed they were not contractually allowed to do the work. Not true. They are in no, well, look, short of them having some specific contract, which I've deposed Mark 1 a number of times, there's no written contract with any carrier that I know of that somehow limits them from doing the work. But that's absolutely evidence that you can use. From my most recent review, Pennsylvania doesn't have the same requirement when it comes to providing a contractor that can do the work. However, you absolutely can still use that to say, carrier, there's no one that's going to be doing the job for this amount of work. Clearly your payment is not sufficient. We need to talk about this and readjust the claim. If you put that in writing and they still refuse, I think that's going to be really good grounds for a bad faith claim. There is really great law. Pennsylvania is easier for bad faith, and their statutes are better when it comes to unfair claims practices for outlining. In essence, the knowing underpayment of a claim is going to be bad faith pretty easily. That you've got a really good case there. So I would be happy to talk to you about that one a little bit more. All right, ladies and gentlemen, that is all of the questions that we have for today. I really appreciate your feedback. You know, I never have as much time as I want. I mean, understanding a policy usually is going to take you more than an hour for me to try and teach that. But hopefully this gives you some baseline as to where to start, what to look at, really how to understand how these policies work. Again, the really big takeaways are read the policy, really, really read the policy, and think of it like a flow chart. If you go through it and just walk through that one step at a time, I've got my coverage here. Great, it says unless otherwise excluded. Let's go to my exclusions. None of these fit, or maybe one of them does fit, but there's ensuing loss coverage. I end on ensuing loss coverage, I'm covered, right? As long as your ending point is a spot of coverage, then you're okay. If you have any questions, please contact me. I forgot to put my slide with my email and phone number, but you can find it on the website, wdblegal.com. And if you're really interested in getting CE credits for some of this types of stuff, being part of the community, helping the lobbying, and getting more one-on-one time with me and some other great professionals in the industry, you should join Mapia. All right, everybody, thank you so much. I really appreciate it. Have a great day.